Hey guys, what's up, how's it going? My name is Rob and welcome back for another video. In today's video, we're going to be talking all about Canadian-based dividend growth stocks. And in today's video, I'm going to be showing you guys and we're going to be reviewing two Canadian-based dividend growth stocks as well. So some of the best stocks that are out there are actually the stocks that consistently grow their dividends over time. And this, myself, actually as a dividend investor, this is my favorite type of stocks. I like to see dividend stocks that are consistently growing their dividends over the long term. And one of the biggest tests of all time that you're going to see in the market is going to be when a stock can continue to grow its dividend even during a recession, or when the economy is low, or even during a pandemic. If you see like these struggles that the companies or just the economy in general is having, if you can find stocks or if you have stocks in a portfolio that are consistently growing their dividends even during these hard times, then you know you definitely picked a good quality stock. Now, as a dividend investor, you're probably going to be focused on two different types of dividend stocks. The first stock we all kind of know of is going to be that dividend stock that has that high yield. So this is a stock with a very high yield that's going to give you passive income today, and that's what the focus of these stocks are. Now, the other type of stock that a lot of people don't really talk about as much, or you kind of learn after the fact, is the dividend growth-based stocks. Now, these stocks are a little bit different. They typically have a lower yield, but the focus of these stocks is to grow those dividends over time, as well as tap into stock appreciation as well. Now, I'm a big fan of both types of dividend investing. I do like to have stocks that have high yield, but I also like to have stocks focused on growth as well. I like to blend the two inside my portfolio, and I think for most people, that's going to be kind of the main thing you should be doing. What you can do is you can kind of focus on whichever one you prefer, but I do think it's important to have a mixture of different types of dividend stocks inside your portfolio. So in today's video, we're going to be focusing on dividend growth, however. So we're going to be looking at the stocks with, generally speaking, low dividend yields, but these companies have potential to have big earnings, and they have companies that have potential to get a lot of growth, as well as grows those dividends over time. All right, so let's jump into the first stock that we're going to be taking a peek at in today's video. So the first stock we're going to be talking about today is going to be Metro Inc. or Metro Incorporated. This is those Metro grocery stores that you see around. The current price of the stock is $72 Canadian and 64 cents. You can find on the TSX with the ticker MRU, as you guys can see here, and the current dividend yield of this company is 1.51%. And just a quick little overview of Metro Incorporated. Metro is a Canadian food retailer operating in the provinces of Quebec and Ontario. The company is based in Montreal, Quebec, with a head office. And Metro is the third largest grocer in Canada, just behind Loblaws companies and Sobeys. Now, there's a lot of different things you can look at when it comes to assessing a dividend growth-based stock. Now, in today's video, we're going to focus on one of the basic things you can do, and that is looking at the company's past history. And since we're focused on dividend growth, the first thing we're going to start off with is looking at the company's history in regards to growing its dividend over time. Now, when it comes to dividend growth, everybody has a different opinion here, but since you're focusing on stocks with lower yields, you really want stocks that are growing their dividends at a pretty aggressive rate. Anything around 5% per year is going to be kind of average, but we really want to shoot a little bit higher. I personally like to see stocks that are growing their annual or average dividend growth rate at around 10%, or even ideally even higher than that. So looking at the past 5 years, we can see that Metro has increased its dividend at a pretty aggressive rate. In 2018, we've seen a dividend increase of 11%. 2019, more or less the same. 2020, we've seen a pretty big dividend increase of 12.5%. 2021, 11%, and then 2022, 10% as well. So Metro is aggressively growing its dividend over the past 5 years. And we take a quick peek at its long-term history growth. We can see since the beginning of 2011, we've seen consistent dividend growth with this company. So that is a good thing, and that's always something we want to see with companies like Metro. And one thing that a lot of beginner dividend or dividend growth-based investors seem to forget is the stock appreciation and stock growth of a company. Because we're focused on a low dividend yield right now, we're going to have to make up for that in terms of stock growth as well. So we want to see stocks that are aggressively growing in stock price. Now, I'm just on Google here. We're going to take a peek at Metro really quickly here. So over the past year, Metro has been up 24%, which is very, very good for the stock. Now, once again, we want to look at the broader range. So if we go to the past 5 years, we can see a return of 71%. So once again, the past 5 years, Metro has done really well. But once again, we can also look at a broader range, which would be the max range here. And since the beginning of 2012, we've seen this company grow up 306%. So that's very, very good stock growth. And like I said, because we have a low dividend yield, we want to see that stock grow as well with the dividend. And if we go over to basically combining the stock growth with the dividends, we can see that over the past year, with dividend being reinvested back into Metro stock, we've seen an increase of 26% in terms of stock overall returns, Over the past 3 years, we've seen an overall return of 51%. And over the past 5 years, you would have got a 90% return investing in the Metro, which is almost 100% of your investment over the last 5 years. And the last metric we're going to take a peek at for Metro is going to be the payout ratio and the free cash flow. So this is kind of basically telling us, how much money in terms of earnings are the companies paying out for its dividends. Typically speaking, we want to see a low payout ratio. Anything under like 40 to 50% is very, very good for a dividend growth based company. I'm going to be comparing Metro, George Weston, and Dollarama here. I got them all selected here. Metro is going to be the green one here, so we can see Metro over time. So the past 5 years, this is the average annual dividend payout ratio. So Metro is obviously hovering around that 20 to 30%, which is very, very low. This means that they're saving a ton of its revenue, and they're going to be using that revenue to grow the company. And of course, they can continue to use that free cash flow and that free revenue to grow its dividend aggressively. And the tool that I am using to do some of the research inside today's video is Inverse. So if you guys want, you can sign up to Inverse. It's completely free to sign up. And speaking of which, we just launched a dividend investing group for beginners. It's slowly growing in Inverse. Once you guys sign up, you can navigate to the group section and feel free to join our group. And you guys can see some of the behind the scenes stuff and some of the small little updates that I've been posting when it comes to my dividend portfolio. So check out the link in the description of the video to sign up to Inverse if you guys are interested in that. And the second stock that we're going to be talking about today is going to be a brand new stock to this channel and a stock that I haven't really talked about before in a pretty cool sector, and that is Torment Industries. So Torment Industries is a cool little company. I'll go through it really quickly here for you guys. It currently trades for $120.84 on the TSX. The ticker for Torment is TIH, so you guys can remember that if you guys want to look it up. And the current dividend yield is 1.3% for this stock. And just to give a quick little introductory to Torment, so this is a equipment-based company. They mine out different types of equipment to people around Canada. They're kind of, I guess, big at the mining sites. They sell these big, they rent out these big, I guess they're called cat trucks. And you've probably seen these before, like the Bobcats and different things like that. So they lend these out. They're kind of equipment lender and do all kinds of cool things. So, obviously with a lot of that stuff booming in Canada over the past little while, we can kind of see how a company like this has done quite well. So that's a quick little introductory to the company and kind of what they do. But this is a brand new stock for me. So it's actually cool to do this video to learn more about them. So just like with Metro stock, with Torment, we're going to go through a few things and we'll talk about some basic things here. We'll look at the same things and we'll compare the two stocks since they're completely different, two different sectors, two different types of stocks, and we'll compare them together. So just like with Metro, because we're looking at a dividend growth based stock, we want to see stock appreciation. We want to see stock growth. And Torment is a stock that definitely has had that over the past few years. The past 1 year return for Torment just in stock appreciation, this isn't dividends, but just stock appreciation, is 24%. So they had a pretty solid year. Last year would have been a good investment. Over the past 5 years, it is up 161%. So this stock has basically exploded. And we've seen that coming kind of towards the end of 2020 to 2021. This stock just kind of exploded. This could be from construction. This company, as you'll see in just a second when we do a quick little overview, it is an equipment provider. So a lot of construction going on, different things like that. Price of materials and things going up, that might have something to do with it. But we've seen some tremendous growth from the stock and long term since the stock first started way back in the beginning of, it looks like 1996 is what we can see from the data here. Started trading at $2 Canadian. It now went up 4,694%. So obviously the stock has went up. It's priced pretty high right now, but you know what? That's just the way it is. It's up to you guys to decide. Looking at some things here, I think it is definitely a good quality stock, and we should see some growth. It's still not priced. I still think there's some room for growth with a stock like this, but in terms of appreciation, this stock has definitely done quite well. And you guys can look at things like the price to earnings ratio and whatnot if you guys want to kind of assess that for yourself as well. So just like with Metro, we will look at the dividend growth for this company, and we're going to go back to dividendhistory.org to just type it in really quickly, and we can see really quickly how much this stock is actually going to dividend on an annual basis. So we have data all the way back to 2015, it looks like here. Torment raises dividend in 2015 by 13%. Looks like there's a little bit of a break here. This might have been missing reported data. But we'll have to double check this when we look at the long-term dividend growth. We'll do that in just a second. But in 2018, we saw a dividend raise of 21%. 2019, a dividend raise of 17%. 2021, 13%, and 2022, we've seen a dividend raise of 11%. So once again, this is pretty aggressive dividend growth, a little bit higher than Metro, and once again, that yield is currently sitting at 1.31%. And if we average out those 5 years, we can see that this is an average of 14% per year over the past 5 years. And over the past 10 years, Torment actually has a dividend increase of around 11%. So once again, pretty decent, consistent dividend growth. In the past 5 years have been really aggressive, sitting at that 14%. That's quite a bit of dividend growth over the past 5 years. But once again, the long-term data still shows that Torment is a good, solid, consistent dividend company that is regularly increasing their dividends. And one more thing I want to point out really quickly is with a company that's aggressively growing its dividend and a stock price that's growing quite a bit, as we've seen, we want to look at some things like earnings growth to make sure the company can support that and keep growing. And one of the cool things here is the earnings are forecast to grow 11.8% per year, and over the past 7 years, Torment has grown its earnings about 13.7%, which is quite a bit of earnings growing over the past 5 years. That's pretty consistent. So once again, if we're seeing that big stock growth, we're seeing those big dividend increases, we want to make sure the company is increasing its earnings on a regular basis, and we have seen that from the stock. In terms of combining the dividends plus the stock appreciation and stock growth, we can see that this company has done quite well. Now, obviously, we can't predict in the future what's going to happen, but if we look at the previous history, we can kind of get a good idea of the quality of a company and what we can expect. Now, obviously, this company's had tremendous gains over the past 5 years, as we can see here. The 1 year return is 24%. For stock appreciation, the 3 year is 72, and the 5 year is 161. Now, obviously, that's probably not going to happen in the next couple of years, but we can expect to see is good quality growth and consistent growth. And if we include the dividends here, we can see that it's quite a bit more growth. You can see these numbers jump up quite a bit with that dividend growth, being reinvested into the stock and those dividends growing over time. Really helps to compound and make a big difference over time. And the last thing we're going to kind of take a peek at is the payout ratio. So we look at the company in terms of its earnings. We've seen its earnings are increasing. We've seen that they're increasing their dividends. We've seen that the stock price is increasing. The last main thing I like to look at just for a basic assessment is going to be the payout ratio. And once again, this is just determining how much that money is being paid out to investors and how much are they keeping for themselves. So we got some other companies here we're going to compare. We have Fining International and Parkland Fuel Corp, just some comparisons here. And we can see that these companies have some pretty high payout ratios. And we can see Torment is going to be this green one at the bottom here. We just kind of highlight it. You can see that's going to be Torment here. We can see a pretty low payout ratio of around 30%, 34%, 29%. And as you guys can see, the earnings increase, we've seen the payout ratio goes down, and that makes sense, right? So nice, good payout ratio of about that 30%. So the tons of room for growth in terms of growing its dividend, and also room for the company to take some of its money and invest it back into itself to grow even further. Alright, so as you guys can see, this is some basic assessment of two good quality dividend stocks that we talked about. I just want to show you some basic factors and some basic things you can assess when you look at potential dividend growth based stocks. So Metro and Torment were two brand new stocks on this channel, so I thought it was pretty cool to talk about them. So like usual, guys, let me know what you guys think in the comment section. If you guys need any help or you guys have any questions, feel free to post them in there. And if you guys did enjoy the video, please be sure to give it a big thumbs up, and remember to subscribe to the channel if you guys want more dividend based, Canadian based stock content. So thanks for watching, guys. I'll see you guys later, and have yourself a good week.